Welcome back, investors, to Ticker Time News. I'm Adam. Thank you for joining me for the After Hours show. It is a great honor to be here with you. Now, remember, the most important thing, not about the market in particular and what I want to talk about, but what's on your mind. So if you do have a question, leave your ticker symbol and question in the comments, and we will go over it live on the show. Now, before I jump into my opening monologue, I've got two announcements I want to make. Number one, I said yesterday in the Catalyst Watch video that if you guys wanted a Discord server, I would set one up. All I needed is someone to say, yeah, sure, we would find that useful. And I got the person. So I am going to set up a Discord for us so we can use. So more on that in the future. I hope to have that up by the first week in January. Okay. All right. The second announcement, I've said it a few times now already. Webull is running a fantastic promotion. They are giving away 5 free stocks for opening an account. And right here on their landing page, middle box right here, it says deposit any amount. So no more, you need to deposit $100, $200, $500 to get certain rewards. It's you open the account, which is free to do. You deposit any amount, $5, $10, it doesn't matter. And then you get 5 free stocks. That is free money, folks. And it just takes a few minutes really to download the app, set it up, or go to the website. Now, to get the 5 free stocks, go to tickertimenews.com/Webull. It is the second link in the description of this video. This is an excellent deal. 5 free stocks to start off the new year with on a clean slate. So take advantage of this while it lasts. And it's for new account persons only. All right, now that I've got that out of the way, let's go ahead and talk about the market. There was some fear in the market today. And in yesterday's Catalyst Watch video, we talked about it in the very beginning about this market environment that we are in and the fears of the Omicron variant spreading throughout Europe right now in New York City. It really weighed on the markets today. And a lot of stocks got beaten up today. There were a few winners, but not too many. So let's talk about this and the dynamics of what's going on. So here on the screen, this is the S&P 500. You can see that during yesterday's Catalyst Watch video, I said it bounced right here on its 50-day moving average on Friday. And then I put this blue line up here. And I said, if the market starts heading in this direction and it can reach this blue line and cross it, that would be a signal of a strong market. And that was last Thursday's high for the S&P 500. Well, today it dipped below the 50-day moving average. So that puts it now in a weaker position. So Wall Street just tumbled today for the most part. As investors, they dumped travel stocks, they dumped big tech, and of course, growth stocks. Now, there were some winners, and we'll look at those because a few of them were on the Catalyst Watch video from last night. And this was all among fears about the rapid spread of the Omicron variant of the virus and the impact of tighter restrictions on the global economic recovery. The Dow ended lower by more than 400 points. The S&P tumbled 500, and the S&P 500 tumbled 1.1%. The NASDAQ dropped 1.2%, and the poor old Russell 2000, that's the one that has the biggest swings on a day-to-day basis, it dropped 1.6%. Now, growth concerns were driven by, of course, the new COVID restrictions in Europe. Word from Senator Manchin, He said that he would not support the $1.75 trillion Build Back Better Act and a view that the Fed could be tightening its policy with bad timing for next year with the variant spreading. Now, I see this new variant as, yeah, it's spreading and it's spreading quickly. I can see that. Two, it doesn't appear as though hospitalizations are going up at the same rate that cases are going up. So does that mean that this is a weaker strain of the variant? Yeah, I think it does, which could actually be a good thing. It could provide natural immunity, but I'm not going to get into that, okay? That's for you and your doctor to talk about, not for me to talk about. I will add that if this is the case, then some of these headline articles that you see about the spread may be just FUD for the market, fear, uncertainty, and doubt, and may not necessarily be a really bad thing like Delta was or the original. But okay, moving off of that. That's not what we talk about on this channel. All right, so sellers did maintain control of the market until shortly after the close of the European markets, which was about 11:30 Eastern here in the States, the United States. Buyers did step in at that moment. You can see it on the charts around that time. Now, I think they were looking for maybe an oversold market, maybe a market that maybe there's some entry points here that actually make sense on certain stocks that got beat up the worst, right? So I think they were looking for good entry points. On the S&P 500, trading below its 50-day moving average that we talked about, which is at 46.08 right now, is where that stands. And it was down as much as 4.3% from its intraday high from last Thursday. So that's where that blue line is that I drew across the top here for the S&P 500. Now, the S&P 500 still closed below that key technical level, but 2 of the 11 sectors did sneak out in positive territory. You got utilities up 0.1% and consumer staples up, oh my goodness, they're so slightly, 0.04%. It's green, right? Now, financials were down 1.9%, materials 1.8%, industrials 1.7%, consumer discretionary also down 1.7%. Those were the sectors that performed the worst. Now, Moderna, they fumbled a 9% gain and closed the day lower by 6%, even though the company announced encouraging preliminary data for its COVID-19 booster shot. Oracle, poor old Oracle, they just can't have any hope right now. They fell another 5% today on confirmation of its acquisition with Cerner for $95 a share in cash, or approximately $28.3 billion in equity value. We have a deep dive on that in just a moment. Everywhere else, a Stampede Treasury yield curve signaled a more constructive perspective. The 10-year Treasury yield, it increased 2 basis points. That's it, to 1.42% after trading at 1.35% overnight. Interesting, right? I think so too. All right, Bitcoin held pretty strong today. BTC USD on the chart. I use TradingView for all of my charting that you see here. There is a link in the description below for a free account. We've been talking now for days and days. We talked about it last night in the Catalyst Watch video about the 200-day moving average and how Bitcoin right now is just hugging that 200. It's staying below it, but it is hugging right up underneath that 200-day moving average. And it's staying right there for now. It's up almost 0.5% right now for the day. So that's good. It's moving sideways. That's much better than moving down like the rest of the market did today. So with maybe some of the tech sector stocks being down today, is it possible that some of that money came out and went in to crypto? Maybe. With Bitcoin being up nearly 0.5%, you have to wonder, where did some of that money go that exited the market and could it have come here? Now let's look at Ethereum, ETHUSD. Ethereum looks a little bit worse on a daily basis. It's down 0.6% right now. It's right at that 3202 right now. And that it's been holding in the 39s for several days now. But I drew out this purple trend line here. It was acting as support for a while, but I drew it out a little further today, and it came right across the past few days. Over the weekend, it's on top of, it's under, it's just bouncing around on this line. Now, that line doesn't have any real significance besides it was used as a support area back in December and November. But more recently, that support level at $3,900 seems to be the more substantive area of support for Ethereum. And now it's below that 39. It's 38.97 right now. So it's dropping right now as we speak. But it is holding around there. I mean, today it did get as low today as a 37.54. So it's dropped today. But one thing I do find interesting with today's drop, the drop 4 days ago, and then you go back 6 days, 7 days, 8 days ago, this ascending trend line here is nearly acting as support on many of those days I just mentioned over the past 2 weeks. It has dipped below it, but it tends to rubber band right back above it. So this ascending trend line here, it would be good if the bottom wicks of the candlestick can stay above that ascending trend line, because then we're going to be putting ourselves into a type of wedge pattern if that continues and holds throughout this week. And one thing too, I should have started this off. This is a short week. Remember, the markets are closed on Friday for the Christmas holiday. I should have mentioned at the very beginning. I'll make sure to do that the rest of the live streams we have this week. So there's Ethereum. It's 38.98 right now, so it's flirting with that 3,900. But I do find it interesting that it is kind of staying above this ascending trend line for Ethereum. Okay, moving off of Ethereum, we had a couple earnings today that I want to mention. They were on the Catalyst Watch video last night. One is, the first one is, and we'll go through these rapid fire as quickly as I can, and then we'll get to the deep dives. BRZE, ticker symbol is BRZE. They're a new company. They haven't been on the market very long. Last night I said that this was an interesting and intriguing play, and I was wondering if maybe the overall environment might keep a lid on how much the stock could go up. It was up 3.5% today. That is a really nice gain for a day like today in the markets. So they had their earnings. They came out earlier this morning, pre-market. They beat by 44 cents, and they beat on revenue, and they issued upside guidance. Excellent. Trifecta, right? You beat on your top and bottom lines, and you give good guidance. Yeah, that's what it's about for earnings. So they're looking pretty good right now. But in our current environment, I don't know how much this is going to hold. It did go up even more today. It got to, right now it's at 64.41. It got to a high of 66.49. So it even went up a couple extra dollars, but then came back down. And I really wonder if our environment kept a lid on extra growth that they potentially could have had today. It's a possibility. All right, a next one, which is a Kathy Wood favorite stock, Blade Air Mobility. Ticker symbol is BLDE. They posted their Q4 results today. They were up 4.5%. So again, not a bad move. This has been a very choppy stock. It has its rallies and it has its pullbacks, but it reported for Q4 net losses of 9.2 million versus 700,000 loss that they had in the same period in 2020 and a $1.6 million loss that they had in 2019. Now, they had revenue of $20.3 million, and that was up for 144% year over year. So a really nice gain for them. They said that their short air delivery business is doing good, and it's doing better than it has in its history. I believe that's what they said. So they're looking good. This is one that wants to change the future of aviation and short transports. I think they'd really, really like to have some sort of a flying car drone type thing, right? So again, it's a Kathy Wood favorite. It's a choppy stock, though, if you want to be in it. It might be better to trade on the swings for now. Okay, next one up is Nike, NKE. Now, I was really curious to learn and understand with Nike about the supply chain and input costs for a manufacturer, and maybe what Nike could say regarding other retailers, other shoemakers, and so forth. Now, I haven't had time to go through the earnings point by point and look over them, read the transcript from the call, but I do have the top line numbers. It was their Q2, and they had an EPS of 83 cents, which beat by 21 cents on revenue of 11.36 billion. And that was only a 1.1% year over year gain. But that did beat by 110 million. But that is slow growth for Nike. So yeah, they were down 2.7%, but they were up 3.2% on in after hours based on earnings. So they made up for what they lost today, and the stock is trading up here at about what it opened at on last Friday. So that's where it's at, but it's still under its 50-day moving average, which is, you know, a weak sign for a stock. Remember, above 50-day moving average, it's positive, bullish. Below the 50-day moving average, and it is negative and bearish. All right, next company that I want to talk about, they had earnings also, is Micron Technology. Ticker symbol is MU for Micron Technology. They reported their Q1, and they had an EPS of $2.16 that beat by 5 cents on revenue of $7.69 billion. That was actually a decline of 7% quarter over quarter, but it did beat by $10 million. Kind of interesting there. Micron was down 1.1% during the day, but after hours, with the earnings when earnings came out, the stock jumped 6.5% in after hours. So the stock is up here near its highs from last week. Definitely jumping back above its 21-day moving average. It's been a rapid mover here over the past 2 months. from October, November, and then December. It kind of hit a slowdown there, moving sideways. I was concerned that maybe with this sharp rise that earnings might have been maybe already priced in, maybe, but no, it jumped 6.5%. So it did really good in after hours. Okay, let's do a few deep dives. Okay, now remember, the most important thing is your question. So if you do have one, please, you can ask it at any time. As multiple concerns dampened the markets today, I think Signet Jewelers, ticker symbol SIG, is a company worth keeping on the radar for its great forward PE ratio of 7.3 times. It's got free cash flow yield of 23% and a solid momentum heading into 2022. Now, this is a jewelry manufacturer. It owns a bunch of them. We'll go over that in just a moment. The stock has shown weakness since November the 22nd, when its recent downtrend here. It is below its 50-day moving average, so that is a negative weak sign. It is down here flirting with its 200-day moving average, and if you look at this over the past year here, it has been moving in the up and right on your screen. It had one little hump here from earnings. It just got a little overextended. It pulled back, and then it continued marching on. And then recently here, it also did the same, had a double top, and then it's reduced, fallen back down. It was down 4.8% today. Now, I see this as a potential buying entry point for Signet Jewelries. Okay. The stock, as we just mentioned, has particularly been a victim of the weakness in the market, especially today, creating what I think is a pretty nice entry point for long-term investors. The retail jewelry, they own Kay Jewelers, Zales, Jared, and per a recent acquisition, Diamonds Direct. Since then, Signet Jewelers has posted 2 earnings reports, and since then means since the acquisition, they've posted 2 earnings reports and correspondingly appreciated about 13%. Within those reports, Signet Jewelers demonstrated that specific strategies it is pursuing are now initially successful, including by alleviating dependency on holiday-related sales. I mean, think about a jewelry store, Kay Jewelers, for a moment. When do you see ads on TV for Kay Jewelers or Zales or any of the other ones? Christmas, Valentine's Day, Mother's Day, right? They used to be very seasonally. They had a seasonality to their business because that's what they focused on. They pumped out ads over Christmas. Get that necklace for your mother, for your girlfriend, for your wife, right? Well, they are moving away from holiday-related sales. Yes, they're still doing them, but they're moving away from not to be dependent on the seasonality that comes with that. And it's also been working on strategies for consumers patronizing malls. They want to get away from malls. With many other events having been reduced or canceled over the past 2 years, Signet Jewelers stands to benefit from pent-up demand in 2022. The impact of shying away from its dependency on holiday cycles was most evident in Q3. In the quarter, Signet Jewelers' same-store sales jumped nearly 19% year over year and over 30% from 2019. That's pretty good because 2019 was a good year. Even though there were no major gift-giving events to spur sales in that quarter, it is worth mentioning that Signet Jewelers grew same-store sales in the quarter, even though the company operated with 400 fewer stores relative to 2019 and retail foot traffic below pre-pandemic levels. Now, the company also guided Q4 comps of 6 to 9%, signaling a solid improvement from its average Q4 comps of a loss of about 0.5% for the last 5 years before the pandemic. Q4 comps are stacked against a 7% growth rate from the year ago period, representing continued pent-up demand from consumers. Signet Jewelers is also focusing on transitioning from mall formats to move production product. Oh boy, live streams. Here we go. To move its product off mall locations. It's a much better setup. For example, Signet Jewelers has increased the off-mall penetration of its K Jewelers brand by 4% over the past 2 years. Almost half of K Jewelers locations are now outside of malls. Signet Jewelers noted that growth in its off-mall locations, it's outpacing that of its traditional mall stores. This has been true for many off-mall based retailers, especially during the pandemic. For example, Kohl's, ticker symbol KSS, noted in its Q1 earnings that its off-mall presence is a critical competitive advantage as consumers appreciated the extra convenience and the open air versus enclosed malls with many different stores and many different consumers. Lastly, Signet Jewelers continued to expand gross margins in Q3, up 380 basis points year over year and 630 basis points on a 2-year stack of 37.4%. A significant component of its margin expansion comes from Signet Jewelers' focus on reducing cost, primarily through reducing employee and inventory turnover. For example, new employee turnover was down 60% in the quarter as Signet Jewelers' actions over the year started to bear fruit. Furthermore, inventory turnover fell 50% due to Signet Jewelers offering more customer fulfillment options, such as in-store pickup and ship from store. Overall, Signet Jewelers is showing that its strategies are paying off, boding well for the company as it heads into 2022. With 2.6 million weddings estimated to be held in the US during the year, the most in nearly 3 decades, there's a lot of people ready to get married right now. Signet Jewelers is at the forefront of a very strong tailwind. Although, I have to admit, the Omicron variant increases the risk that such events may be canceled or pushed back. Those concerns could be overblown, especially given the presence of mass vaccinations and other treatments that were just beginning to roll out in late 2020 and in early 2021. As a result, Signet Jewelers is a solid choice for buy and hold investors heading into a very positive new year. As always, remember to set a stop loss limit order. It's always a good idea when you're starting to grow your position. Okay, what do you think about a jewelry store as part of your portfolio? Could you see it happening? And with all those weddings coming up, that's a lot of potential sales for a company who owns a lot of different brands of jewelers. I used to remember when buying jewelry, I would have K Jeweler, I would have another brand, and they both would be from Signet Jewelers. So as a consumer, it didn't quite matter where I decided to go shop because the parent company was the same. So that too bodes well for Signet Jewelers rolling into 2022. All right, let me know in the comments what you think. Okay, moving off of Signet Jewelers, I want to talk about Oracle. Oracle has had it rough. Let's pull up that stock chart. It's ORCL for Oracle. Now, they took a big drop before earnings. They fell out of their trading channel that they had been in really strong this year, really strong. From the end of February, it started in this channel and it was just moving right along, obeying the lines that were here for support and resistance. But then we got to earnings here, and just before earnings, there was a sell-off. Earnings happened, and this thing popped all the way to the very top of the trading channel. So it went from down here underneath the trading channel, under the support line, under the 50-day moving average line, and then earnings came out and it popped to just under that resistance line in the trading channel. Really fantastic move there. It was a 15.6% move, if I remember correctly. Now, it is selling off, down 5%, 5.1% today. It's back out of its channel. It's under its 50-day moving average. Why is that? Well, Oracle could have some big changes. So, Oracle, ticker symbol ORCL, foresees a bright future in the healthcare space with addition of Cerner. But there are many risks in this strategy shift. This morning, earlier reports that Oracle is seeking to acquire Cerner, a provider of digital medical records, became reality when the two companies announced a massive $28.3 billion all-cash transaction. Recall that on last Friday, the Wall Street Journal broke the story that acquisition talks or discussions were underway, sending shares of Cerner shooting up about 13%. That move did not fully encompass the eventual buyout premium, but Cerner shares remain about 4% below the $95 a share offer from Oracle, reflecting some hesitancy from investors. Specifically, there are many, or there may be many, doubts that a deal of this magnitude, which will hand Oracle a powerful position in the healthcare industry, will receive regulatory approval. Additionally, Cerner shareholders could ultimately reject the proposal. Indeed, a tie-up between Oracle and Cerner is a blockbuster development that has major implications for both companies and the healthcare space. In fact, this acquisition would be Oracle's largest purchase in the company's history, which is saying something because the company is no stranger to making a big splash in the M&A market, which is mergers and acquisitions. However, even Oracle's highest profile acquisitions, including its $9.3 billion NetSuite deal in 2016, pale in comparison to this buyout. It's not difficult to understand Oracle's interest for Cerner. For starters, co-CEO Safra Catz points out that healthcare represents a massive $3.8 trillion market in the US alone. The addition of Cerner, which is already a large customer of Oracle's, would provide it with a substantial presence and competitive advantage within hospitals and healthcare systems. With Oracle's digital capabilities on board, most notably including its hands-free voice interface to access cloud applications, the combined company could benefit a clear-cut market leader. Importantly, though, a large portion of Cerner's business already resides within Oracle's databases. Therefore, the primary goal is to take that mountain of data and to make it much more accessible, increasing efficiency and reducing workloads for healthcare providers and administrators. To achieve that objective, Oracle plans to improve the user interface, making Cerner systems easier to learn and use. From a financial standpoint, acquiring Cerner would provide a significant multi-billion-dollar boost to the top line. The deal is also expected to provide gradual growth to adjusted EPS in the first year after closing, with substantially greater EPS contributions thereafter. Although the company did not specify how much improvement there would be. At about 5 times Cerner's trailing revenue, Oracle's offer price seems reasonable, allowing for the deal to enhance its earnings. One uncertainty revolves around how Oracle intends to finance the transaction. Presumably, the company will use a combination of cash on hand and new debt, which could explain why investors are less than thrilled about the acquisition, as illustrated by the stock's 10% dip since last Friday. The company already has over $78 billion in total debt as of November 30th, so significantly tacking on to that hefty balance may not go over too well with investors. Furthermore, there may be concern that integrating such a massive acquisition could disrupt Oracle's momentum in its cloud business, NetSuite ERP and Fusion ERP, which has helped propel its stock to record highs. You can see it on the chart here in front of us. The main takeaway is that Oracle's acquisition of Cerner could transform it into a powerhouse in the healthcare field. But the deal is far from a slam dunk, as regulatory and shareholder approvals may stand in the way. How should I say it? The lure of making a transformational acquisition of this nature is certainly understandable. But I felt that Oracle was finally on an upward path prior to this news. My concern is that the company will take its eye off the ball as it's focusing on acquiring Cerner. What do you think about Oracle and Cerner and the acquisition? Do you think this move into healthcare is the right move for Oracle at this time? Seems to make sense. And what do you think about the debt? Will it be too much? And will that debt hurt the company in the short term and the long term? Because as interest rates go up, that could mean that its debt will cost more. Let me know what you think in the comments below. Okay, let's get to a sweeter topic. Krispy Kreme donuts, or just Krispy Kreme. Ticker symbol is DNUT. Now, Krispy Kreme, it is one that has tried to go public before. It's been back and forth, but it did finally IPO earlier this year on July 1st. And it had a pretty nice acceptance on the market. But then it had a sell-off, missed on earnings, then rallied, sell-off, and then it's been in a more, let me put a trend line here on the top so you can see this. The move up recently, since back here, since bottoming on the 29th of October, that's a pretty steep trend right there. Now, if we clone this line and bring it down, you'll see that it doesn't match up. So it's not moving together. If I had to try to put a trend line on the bottom here, it would be a little more in an opening, as in the price swings are moving more rapidly. I mean, look, today it's down 7%. On Friday, it was up 10%. And then a 2.5%. It's making these big moves. There's one down 6.5, one up 10.8. So it's making really big moves, which can be a little concerning for investors. Now, with Krispy Kreme's nearly 7% decline today, and again, their ticker symbol is DNUT. I believe Krispy, oh my goodness, sorry for that alarm going off. Live stream again, right? It made me lose my train of thought there. Okay, Krispy Kreme, ticker symbol DNUT, is not getting sprinkled with much enthusiasm. It's down nearly 7% today, even though the company raised its fiscal year 21 revenue guidance above estimates. The donut and coffee house chain now expects to end fiscal year 21 with revenues of $1.37 to $1.39 billion, up from guidance of $1.34 to $1.38 billion. Krispy Kreme noted that the main reason for lifting its guidance was its successful pass-through of price hikes that took effect in September and November in the US. The company is also benefiting from a strong holiday season. Nonetheless, Krispy Kreme is leaving investors feeling a bit empty today. A significant culprit is heightened concern over the Omicron variant. Again, I hate to bring it up, but it is just driving the headlines right now. and it's on investors' mind. But I think that it could potentially be overblown, like I said earlier. But it's still there. Many additional restaurants and quick service food chains, such as Darden Restaurants, ticker symbol DRI, Starbucks, SBUX, are experiencing selling pressure today too. One of the few standouts, though, in a sea of red is Restaurant Brands, ticker symbol QSR, which operates Burger King, Tim Hortons, and many others. Along with QSR, their chains, their food chains or stores, restaurants, fast food, benefit more from takeout like Wendy's, ticker symbol WEN, McDonald's, MCD, and Yum Brands, ticker symbol YUM, that's Taco Bell. They're all withstanding so much better in today's sell-off. The Omicron variant can be especially troubling in big cities, such as New York City right now, which Krispy Kreme identified as an area of focus during its Q3 earnings call in early November. The company was optimistic that the New York City market was, quote, ripe for growth, specifically mentioning that it viewed this market as similar to opening an entirely new country. It expects to fully build out the New York market in about 5 years, as we have seen with Shake Shack, which is predominantly located in and around New York City. This area has been what's the right word to use? It's been hit pretty hard by COVID. And that has put a massive strain on Shake Shack's bottom line. We can see it in their earnings. The same could hold true for Krispy Kreme's expansion plans too. Krispy Kreme also only reaffirmed its long-term targets, such as its expected 9 to 11% organic sales growth and 18 to 22% adjusted earnings before taxes, etc. growth. With the company continuing its hub and spoke transformation, though, which Krispy Kreme's stores, they serve customers and they function as centralized production facilities for shipment to grocery and convenience stores. Investors may have expected that a bump in long-term targets would coincide with a bump in full-year revenue expectations. Lastly, Krispy Kreme is also not helped much by its premium valuation. The stock currently trades at around 26.7 times fiscal year 23 earnings. This puts it at a premium relative to more established quick service restaurants such as Restaurant Brands, ticker symbol again QSR. They're at about 13.8 times. Wendy's, 21.3 times. McDonald's, 23.7 times. Bottom line, despite a bump in the fiscal year 21 revenue expectations, Krispy Kreme is looking quite soft today as investors weigh that what the increased risks of rising COVID cases could have on Krispy Kreme's bottom line moving forward in the New York City market, especially in that market, because it's getting hit pretty hard. Well, just some ramble bumblings there about Krispy Kreme. just some thoughts that I had on this company, because it did come into the market with a lot of fanfare, and a lot of people were glad to see it back. But it's had wild swings recently. Big move down today. And it's just not... I think they were hoping that the economic recovery was going to continue and to be robust. And since there's a lot of FUD right now, it is putting a big lid on what the company can do. So let me know what you think about Krispy Kreme. Is it making the right decision? Is it going to really be able to tap into the New York City market within 5 years? Or is their growth going to be hampered? I don't know. What do you think? Okay, well, that's a rundown of the stocks that I did want to cover today. So if you do have any questions, now would be the perfect time to ask. We can go over any stock you want to. Until then, or not, while I'm closing out here, a couple of things. If you did find this video to be helpful, informative, actionable, then a couple things to do. Number one, click the like button. That shows YouTube that you like this content and it was helpful. Number two, take the URL and share it across your other social media platforms. That tells other people that you like this information as well. And then the third thing to do is to, if you like my perspective on things, then to join us on Patreon. That's the first link in the description below. There is a tier for everyone. And our goal is financial freedom for all. And like I said at the top of this video, I got the request for Discord. So we will get that set up by the 1st of January. So that'll be another added benefit for Patreon members as well. And then finally, if you have not set up a Webull account, second link in the description below, tickertimenews.com/Webull, and get your 5 free stocks. It's free money. You click on the link, it takes you to a landing page, and you sign up right here, open an account, deposit any amount. You know, there used to be a restriction. They may offer 1 free stock, 2 free stocks, but it used to be deposit $100. Now it's any amount, $5, $10, it's okay. And then get your 5 free stocks. It's free money, and who knows? The stocks are valued up to $8,300. That would be a really nice Christmas bonus. Okay. Well, again, that's everything I wanted to cover. Gave a little time there for any questions to come in. So I'll leave it there for today. I do apologize for being extra late today. But I'll be back tomorrow, 5 p.m. Eastern, for another market close live stream where we talk about the markets, we do a couple deep dives, talk about a few stocks, crypto, and most importantly, answer your questions. So thank you all so very much for joining me, and I will see you in the next video.